Bilirsiniz hocam 15 saniye içerisinde.
Hello, everyone. Welcome to this mini course on derivatives. This is the third week of 5-week course on derivatives. Today, we are going to discuss futures. Before we start our discussions on futures, let me briefly go over with what we discussed in our last week lecture. Before I go in my lectures, I'm going to stop video so that connection is okay. 1 minute. Perfect. Last week, I talked about first building block of derivatives, so-called forwards. We define forward as a contractual agreement to buy or sell an asset at a certain time in the future for a certain price, so-called delivery price. The primary use of a forward contract is to lock into a price at which one buys or sells a particular good in the future. This implies that the contract can be utilized to manage price risk. Forward contracts, of course, can be used to hedge against unforeseen movement in the market prices. Likewise, it can be used for speculation purposes in the case of your beliefs and market expectation are different. They are widely used and customizable and can be used for hedging and speculation purposes, but it carries counterparty risk. And the liquidity might be very low, and it is difficult to exit from contract once you sign the contract. That's why we have futures. Now, this week, I'll start talking about derivatives, second derivatives product, so-called futures. I'm going to define what is a future, then we'll discuss contract specification, settlement price, volume, and open interest. We will discuss types of orders and a clearinghouse margins, and then how we can use futures speculation purposes or hedging purposes. And after I talk a little bit about basis, I'm going to finish with advantages and disadvantages of futures contract. As I said, this week, I want to talk about futures. A future contract is a contractual agreement made between two parties to buy or sell an asset through a regulated futures exchange at a certain time in the future for a certain price. Again, the price is the delivery price. Like a forward contract, a future contract is a binding agreement. It's not the right to buy or sell. It is a binding agreement between a seller and a buyer to make and to take, this is the seller, and then to take by delivery of the underlying commodity at a specified future date with agreed upon payment terms. The party that has agreed to buy the underlying asset has a long position. The party that has agreed to sell the underlying asset has a short position. Remember, this is again like future forward contract, contractual agreement between two parties for the delivery of physical assets at a certain time in the future for a certain price. Like forward contract, no actual transfer of ownership occurs in the underlying asset when the contract is initiated. Instead, there is simply an agreement to transfer ownership of the underlying asset at some future delivery date. Just about everything, about anything, you can write a contract on anything. Some CME says, if you can say polite company there is probability a market for it. For example, CME trades future on agricultural commodities, energy commodities, soft commodities, foreign currencies, interest rates, and stock market indices, including, for example, if you look at agricultural commodities, live cattle, feeder cattle, live hogs, pork bellies, broiler chicken, random length lumber. For energy, we have WTI future contract, natural gas, reformulated gasoline, heating oil, and metals. You can copper, zinc, almost on a lot of stuff. And foreign currencies, euro, British pounds, Canadian dollars, and also, of course, the most important one, interest rate, euro dollars, euro market, all the 90-day treasury bill or 1-year treasury bill, 1-month LIBOR, and of course, stock indices. Up until 1970s, the dominant traders are the hedgers. After that, speculator also become a very important part of the markets, especially after 2000. And also, we have seen the development of financial futures contract in addition to commodities. Future contracts are similar to forwards, but unlike forward contracts, they are standardized and exchange traded. Default risk is borne by the exchange clearinghouse, and traders are allowed to reverse what is called offset their position so that physical delivery is very rare. This is true because most hedgers are not dealing in the commodity deliverable against the futures contract. For instance, just think about an airline company which is not going to use WTI crude oil in Cushing, Oklahoma for its operation, but may use WTI futures contract or heating oil as a hedge. That is, most hedgers are basically cross hedgers. Similarly, speculators are just betting on price movements, have no interest in owning the physical oil. Therefore, most hedgers and speculators reverse their position prior to delivery. Another important item here that futures forward is that value is marked to market daily. We will come back to this margin account later on. Of course, standardization is almost everything. Quality, quantity, delivery time, everything has to be written. Basically, we will discuss that one also. WTI contract, what kind of oil you can deliver to where. Everything has to be written. Of course, we will have the different execution details also lead to pricing differences, effects on marking to market, on interest calculation, and everything will affect the surrounding. Futures market perform the risk transfer function of forward contracts, but are more liquid and substantially reduce performance risk, of course. Futures market separate the marketing and purchasing decision. You don't know, for example, in forward contract, it's a two-way. Two parties know each other. In this case, you don't know who is counterparty. You are actually dealing with the clearinghouse. So therefore, you are eliminating the credit worthiness and operational risk so that clearinghouse take those responsibility. As a consequence, futures markets are also useful even when marketing and purchasing do not arise, or portfolio management. If you compare forwards and futures, for example, forwards, it's a private contract between two parties, as opposed to futures, that's exchange traded. Of course, in forwards, it's is a non-standard contract, which is to say you can customize based on client's needs, as opposed to future contract. They are standardized. They are totally standardized. You cannot deviate from the contract specification. In forward contract, usually one specified delivery date, and the future contract, as opposed, it's a range of delivery dates. Basically, if you look at WTI contract, we have monthly contract for 10 years, more than 10 years actually. And the future forward contracts, they are settled at the end of contract. You don't have to do anything between the signing of the contract till the expiry of the contract. As opposed, futures are settled daily, basically through the margin account. And the forwards, the delivery or final settlement usually occurs. On the futures, it is, you generally offset your position prior to maturity. So you don't take necessarily delivery, but it is possible to take delivery after the maturity. Of course, in forwards, there are some credit risk due to counterparties not negotiating through clearinghouse or something. In futures, virtually no credit risk. This credit risk is borne out by the clearinghouse. Each futures contract, but basically, as I said, one of the main difference between forward contracts and futures contracts is the fact that futures contracts are standardized. When an exchange introduces a new contract, it has to specify in some detail the exact nature of the assets, the contract size, delivery points, delivery time, settlement type, whether it is physical delivery or cash settled, and price limits and position limits, and everything about transaction except price, which is, of course, negotiated based on market condition. The underlying assets in the future contract can be anything, ranging from, as I said before, commodities to stock indices, equities, bonds, foreign exchange, interest rate, and so on. However, the exchange has to specify exact terms in identifying the contract. The financial assets in futures contract are well defined, and there is no ambiguity. In the case of commodities, there may be quite a variation in the quality of what is available in the marketplace. When the asset is specified, the exchange has to specify in detail grade and grades of commodity that are acceptable for delivery. For example, when I look at WTI contract in CME, it specifies its sulfur content, 0.42% or less by weight as determined by ESTM, and the gravity not less than 37 degrees American Petroleum Institute API, nor more than 42 degrees API. This has to be defined, all of them. So standardization of futures contract also requires the specification of delivery points and the contract size, which amount of asset that has to be delivered under one contract. For example, in WTI contract, the delivery can be made free on board at any pipeline or storage facility in Cushing, Oklahoma, with a pipeline access to Enterprise, Cushing storage, or Enbridge Cushing storage. At buyer's option, delivery shall be made by any of the following methods: either inter-facility transfer, or by inline transfer, or if the seller agrees to such transfer, and then if the facility used by the seller allows for such transfer without physical movement of product, in tank transfer or title to the buyer. Basically, you have to specify how the delivery is going to be made also. The contract size, on the other hand, is 1,000 US barrels, which is 42,000 US gallons of WTI. Each contract is 1,000 barrel of contract. Basically, basic standardization concentrates trading and hence the liquidity in a small number of contracts. For example, for Chicago wheat, the greatest Chicago wheat, number 2 reds, location, Chicago points, and then dates, January, March, May, July, September, and November deliveries. The fact that futures contract terms are standardized is important because it enables traders to focus their attention on one variable, only one variable, namely price. You don't have to worry about quality or quantity. Standardization also makes it possible for traders anywhere in the world to trade in these markets and know exactly what they are trading and what they are getting. This is in sharp contrast to cash forward contract, in which changes in specification from one contract to another might cause price changes from one transaction to another. Futures contracts are also standardized with respect to delivery months. The exchange must specify the precise periods during the month when the delivery can be made. The exchange also specifies when trading in a particular month's contract will begin and the last day on which the trading can take place for a given contract, as well as the delivery months. For example, WTI futures, crude oil futures are listed monthly contract for the current year and the next 10 years, calendar years, plus 2 additional contract months. The exchange lists monthly contract for a new calendar year and then 2 additional contract months following the termination of trading in the December contract for the current year. Some futures contract, let's discuss physical versus cash settlements. This is very important. For example, WTI light sweet crude oil is physically delivered contract as opposed to Brent futures at ICE, it is cash settled. Some futures contract call for actual physical delivery of the underlying commodity or financial instrument at contract expiry. Others simply call for a cash settlement at the expiry. Generally, market participants do not hold their futures contract until the maturity dates, but rather they chose to close out their position prior to or on the last trading date for the contract. Closing out a position means entering into in the opposite trade to the original one. Traders can offset future contract they have bought by a subsequent sale or offset future contract they have sold. It means they have short position by subsequent purchase. It means they can go long. If you buy 1,000 short contract, in order to offset your position, you need to, you bought 1,000 short contract, and then you have to go long on that one for 1,000 contract. What happens if you don't offset your position before the maturity? This is very, of course, exchange determined, but seller's broker informs exchange clearinghouse intention to deliver, specifying how many contracts will be delivered and where the delivery will be made and what grade will be delivered. The exchange then chooses a party with a long position to accept the delivery. This party does not have to be the original party with whom the seller opened his position. The original party might have already closed his or her positions. Parties with long position must accept delivery notices. They cannot say, no, I'm not going to accept. If they didn't close their position, it's their responsibility. So close out your position if you don't want to take delivery. If you don't, then you might have unanticipated delivery of a future contract. What was the name of the whole book of option? There is a story about JP Morgan broker traders who has bought one long live cattle contract from delivery point was Kansas City. He was supposed to close his position by going short one live cattle contract. What he did actually, buy another live cattle contract. Of course, he has two open long contract. He got a phone call from his broker. He has to take the delivery because he didn't close his position. So he had to go from New York to Kansas City and then wait for a week because the next auction is a week from now. Then he had to find a storage for the live cattle and then sell it in the next week live auction. So in order to avoid such unexpected or unanticipated delivery of a future contract, you have to close out position before the expiration. Even though physical delivery does not occur on most contracts, delivery is important, very important. It is the possibility of eventual delivery that determines the future price. Delivery ties the price of expiring futures to the price of the physical commodity at delivery. Nonetheless, cash settlement can be considered another way to tie the futures and cash markets together. In a cash settled contract, at expiration, the buyer pays the seller the difference between the fixed price established in the contract and the reference price prevailing on payments. Here, as the delivery period, if you look at the convergence of futures and spot, we expect at the delivery, future price should be equal or very close to spot price. Therefore, a lot of people now uses nearby future price as a good proxy for spot price. As the delivery period for future contract is approached here, the future price converges to the spot price of the underlying asset. Suppose that the future price is above the spot price during the delivery period. And the traders, of course, then have a clear arbitrage opportunity. They can sell or short the future contract and buy the asset, of course, and then make the delivery. Of course, it's the risk-free profits amount of which future prices is greater than spot price. As traders exploit this arbitrage opportunity, the future price will fall. At maturity, the two prices will converge. Of course, if there are no other problem in the market. I remember when I was working at CFTC, corn prices were not converging because of delivery points and then how many contract you can deliver. There was some issue on that. But in general, if there is no problem in terms of delivery and everything, spot price and the future price should converge at the expiration dates. Of course, when exchange defines the contract specification, they define also price movements and also position limits. For most contracts, daily price movement limits are specified by the exchange. If in a day, the price moves down from the previous day close by an amount or equal to the daily price limit, the contract is set to be limit down. If it moves up by the limit, it is set to be limit up. Normally, trading ceases for the day once the contract is limit up or limit down. the purpose of daily price limit is to prevent price occurring because of speculative excess speculation. However, limits can become an artificial barrier to trading when the price of the underlying commodity is advancing or declining rapidly due to some economic fundamentals. On the other hand, position limits are the maximum number of contracts that a speculator may hold. The purpose of this limit is to prevent speculators from exercising undue influence on the market. For example, now, especially after 2008 financial crisis, there were lots of discussion about bringing strict position limits to commodity markets in order to prevent excess speculation. I don't know what do they mean by excess speculation, because there is no definition for that one. Anyway, now we have the current month's position limits for the last 3 days contract, 3,000 contract. At most, you can have 3,000 contract in the last 3 days of nearby futures for WTI contract. So let's look at some definition: settlement price, open interest, and volume of trade. Volume in futures market represent the total amount of trading activity or contracts that have changed hands in a given commodity market for a single trading day. On the other hand, open interest is the total number of contracts outstanding that are held by participants at the end of each day. A contract is created by a seller and buyer of contract. Therefore, open interest can be calculated as the sum of all long position, or equivalently as the sum of all short position. Open interest will increase by one contract if both parties to trade are initiating a new position. One new buyer and one new seller in this case. And open interest will decrease by one contract if both traders are closing an existing or old position, one old buyer and one old seller. However, if one old trader is passing off his position to a new trader, basically what I'm saying here, one old buyer sells to a new buyer, open interest will not change because the number of existing contracts stays same. But there is a new volume. So volume of trade changes, but not open interest. If there is amount of trading by day traders, while they are not carrying the position to next day, the volume of trading in a day can be greater than either the beginning of the day or end of the day open interest. Let's suppose there are 3 traders in a day and the following trades occur. Trader A sells to trader B 10 contract. Trader B buys 10 contract from trader C, and then trader A buys 10 contract from trader C. There are 20 long contract by trader B, and then trader C has 20 short contract at the end of the day. The total open interest here is 20, but volume of trade is 30 because trader B buys and sells 10 contracts. That's why you need to add that one. Basically, volume of trade is the number of contract traded in a day. Difference between volume of trade and open interest is just because of what's called activity by traders or existing versus new contract. When you define settlement price on the other hand, this is the weighted average of the price at which the contract traded immediately before the end of trading for the day. For example, WTI contract, it is the price weighted average of last 3 minutes price. This can be different from the last price. Last price is basically last trade, but this is last 3 minutes. This is really important because settlement price generally determines margin or some other settlement stuff. So it's not the last price or close price, but the settlement price generally more important. Here, look at, this is Friday, last Friday, CME, crude oil, WTI future settlements. We can see for each delivery month, we are seeing here the price listings with the first line going to contract that matures next, basically July contract. That is today's 22nd. Oh, today is the last day of July contract. So that's why you are seeing open interest is very low, 39,000. So many people already closed their position. For the last day, there's only about 39,000 contracts. You can see open price for Friday and the highest price and the lowest price. Last price is the last trades, basically, which is made about at 2:30 p.m. on Friday. Change compared to previous day. The settlement price is 39.75. This is very close to last price, 39.43, but it is different because it is the weighted, volume-weighted average of last 3 minutes price. Okay, this is very important. Of course, estimated volume on that day, Friday, it's 81,000 or something. Basically, as I said, the first line matures first, which is the July contract. The delivery is between July 1st to July 31st, but the trading ends June 22nd. This contract, the contract which matures next, also called nearby contract or prompt month contract. Each succeeding line pertains another maturity months. Contracts that mature later are called distant, deferred, or back month contract. For example, the first contract following the nearby contract is called the first deferred contract. And the contract following, that is the second deferred contract, in our table here, for example, August contract is the first deferred contract. And the September contract is the second deferred contract. But tomorrow, we will not have July contract anymore. So August contract will become the nearby contract. That is going to be the contract which is maturing next. But it is tomorrow. Today, it is still July contract is the nearby contract. If you look at, for example, in our table, as I said, July contract, which is ending its trading at the end of today, that contract delivery starts in July 1st. And then it started trading on November 21st, 2014, basically almost six years ago. And the first delivery date is July 1st, 2020, and the last delivery date is July 31st, 2020. The seller is going to inform his intention to deliver on the first notice date, which is June 24th. And the last notice date also basically June 24 at 3 p.m. We have monthly contracts expiring up until February 2031. Basically, if you want to hedge your position for the next 10 years, if you are a producer, if you believe these prices are good for your hedging purposes, then you have the option to fix your prices for the next 10 years. As I said, August contract is the first deferred contract today, but tomorrow it will become nearby contract since it will be the first contract that matures. There are different types of orders in the market. You can have the simplest type of order placed with a broker is a market order. It is an order to buy or sell a futures contract at whatever price is obtainable at the time it is entered in the ring or pits or other trading platform. However, there are many other types of orders. Most commonly used orders, basically, there might be limits or stop orders or stop limits or trade at settlements. A limit order is an order in which the customer specifies a minimum sale price or maximum purchase price as contrasted with the market order, which implies that the order should be filled as soon as possible at the market price. Thus, if the limit price is $45 per barrel for one August WTI contract for an investor wanting to sell, the order will be executed only at the price of 45 or more. Basically, as a seller, you don't want to sell your product or crude oil at a lower price. So you want to have a limit order, the limit order saying, okay, when the price reaches $45, yes, I'm willing to hedge my position. Below that, I don't, because I believe prices can go up further. As opposed to a market order, limits order will not be executed unless the price reaches $45 per barrel. On the other hand, if the limit price is $45 for one August WTI contract for an investor wanting to buy, the order will be executed only at a price of $45 or less. As opposed to market order, a limit order will not be executed unless the price falls to $45. In this case, if the price like $40, then of course it is going to be a limit order is kind of a for buyer is kind of a market order. The stop order or stop loss order is an order that becomes a market order when a particular price level is reached. A sell stop is placed below the market, a buy stop placed above the market's price. The purpose of a stop order is to close out a position if unfavorable price movements take place. Let's go back to our previous example. Let's say you want to close out a position if unfavorable price movements take place. A stop order to sell at $35 is issued when the market price is at $40. It becomes a market order when the specified price has been hit. Basically, you don't want to sell your product less than $35. That's why you are putting a stop order. On the other hand, stop limits is a combination of limits and stop orders. The order becomes a limit order as soon as a bid or offer is made at a price equal or less favorable than the spot price or market price. The two prices must be specified, stop price and the limit price. If they are same, the order is set to be a stop and limit order. Let's say a market price is $40 today. A stop limit order to buy is issued with a stop price of 46 and a limit price of 50. As soon as a bid or offer at 45, the stop limit becomes a limit order at $50, basically. Oh, the last one is the trade at settlement. That is very important because you remember on April 23rd, when WTI price hit minus $37, settlement price, actually it had minus 40, last price or something. Sorry, before the last price, minus 40. This is the price many Chinese investors suffered from because this is orders for trade at settlement. Products are executed at the current day's settlement price for the standard contract or at valid price increments above or below the settlement price of the standard contract. For cotton futures, for example, the minimum price fluctuation is 1 cent per pound. A trader enters an order for cotton trade at settlement, a price of 0. Basically, it means that a trader wants to trade at the at settlement price. Here, why do you enter a trade at settlement? It has a lot of benefits, but of course, you are just entering a contract which you don't know the price actually. Why it is important? Because it reduces uncertainty around the settlement price. Because your contract may be tied to settlement price. Price contract are at or near settlement value, or execute at any point of the trading day rather than waiting for the market close. It is available, of course, CME, Globex, and eligible for block trades. But the most important thing here, because many contracts, physical delivery is tied to settlement price. So if you want to avoid any kind of price risk, you are better off entering a trade at settlement contract to remove any kind of uncertainty for your contract. So let's talk a little bit on the clearinghouse. That is one of the most important differential between forward contract and futures contract. As I said, forward contract is a contract between two parties. There are no middlemen or something. That's why there are counterparty risk. If you don't want to fulfill your contractual agreement, that is the risk for the other party. Here, on the other hand, basically, if two investors get in touch with each other directly and agree to trade an asset in the future, there are obvious risks, as we saw in the forward contract. One of the investors may regret the deal and try to back out. Alternatively, the investor simply may not have the financial resources to honor the agreement. One of the key roles of the exchange is to organize trading so that contract defaults are avoided. Aside from standardization, this is the most important difference between forward contract and the futures contract. They have the exchange to eliminate any kind of counterparty risk through clearing. Clearing is the process by which trades in futures and options are processed, guaranteed, and settled by an entity known as clearinghouse. A complete clearinghouse acts as a central counterparty to and guarantor of all trades that it has accepted for clearing from its clearing members. The clearinghouse becomes the buyer to every seller and the seller to every buyer through the process known as novation. The exchange clearing house intermediates all futures transactions. You don't have to know your counterparty. All you know is the clearing house. Basically, in this example, for example, A and B trade each other, but they don't know each other. They do trades. A sells to clearing house, B buys from clearing house. The exchange is between A and B, but they don't know that one. Clearinghouse knows. But B at any point can offset its position. Clearinghouse appoint another open position to A. Basically, the credit status of counterparty becomes irrelevant and the contract becomes fungible. A transactor needs only to worry about credit status of the clearinghouse. Of course, if clearinghouse becomes so big and it becomes systemically important, there might be some problem over there. But for the time being, let's assume clearinghouse doesn't pose any risk. Clearinghouse have a legal relationship only with the entities that they have been admitted as clearing members. That is to say, clearing houses have no legal relationship with the customers of their clearing members. A and B may be customers of some future broker commissioner. Clearing members are generally institutions such as futures commission merchants and broker dealers that have the financial risk management and operational capabilities to function as clearing members. Clearinghouse perform generally the following duties. They match, guarantee, and settle all trades and register positions resulting from such trades. They perform mark-to-market calculation of all open positions at least once a day and oversee the resulting cash flows between clearing member firms. They manage the risk exposure that clearing firms present to the clearinghouse. They perform the exercise and assignment of options contract. They facilitate, but not guarantee, the delivery of the physical commodities. They permit multilateral netting of position and settlement payments. They assume contracts are fungible and clearinghouse offset the positions. They enable clearing members to substitute the credit and risk exposure of the clearinghouse for the credit and risk exposure of each other. They maintain, of course, a package of financial safeguards that are designed to mitigate losses in the event of a clearing member defaults on its obligation to the clearinghouse. In the event of such default, they meet the obligation of the defaulter by first utilizing the collateral pledged to it by the defaulter. So, one of the key safeguards in the risk management system of futures clearing organization is the requirement that market participants post collateral, known as margin here, to guarantee their performance on contract obligation. In contrast to operation of credit margins in the stock market, a futures margin is not a partial payment for the position being undertaken. Instead, the future margin is a performance bond which serves as collateral or as a good faith deposit given by the trader to the broker. The minimum levels for initial and maintenance margin are set by the exchange. However, futures commission merchants have the right to demand higher margin, not the lower margin, but the higher margin from their customer if they have some belief that their customer might default, then they have the ability to demand higher margin. However, as I said, they cannot require lower margins than those specified by the exchange. To satisfy the initial margin requirements, but not subsequent margin calls, an investor can usually deposit securities with the broker, because the securities generally, these are not interests, because you want to avoid the interest cost. That's why instead of cash, they provide securities which still pays the interest. In a traditional futures market, contracts are margined under a risk-based margining system, which is called SPAN. Portfolio margining system evaluate positions as a group and determine margin requirements based on the estimates of changes in the value of portfolio that would occur under assumed change in market condition. Margin requirements are set to cover the largest portfolio loss generated by a simulation exercise that includes a range of potential market conditions. So higher the volatility, the higher the margin requirements. Basically, when volatility increases in the market, you can see margin requirements is getting higher and higher. Yesterday, when I checked the margin requirements for WTI contract, especially nearby contract, it is close to 40% or something, as opposed to typical 10%. As the maturities, further maturities contract still margin is about 10%, but the nearby and the first and second and third contract margin are really, really high. So that in case of big price movements, clearinghouse can avoid any kind of counterparty risk. Let's look at, sorry, let me go back here. Marking to market ensures that future contract always have zero value. Hence, the clearinghouse does not face any risk. The marketing to market takes place through margin payments, as I said. At the inception of the contract, each party pays initial margin, typically 10%, but it is determined by the exchange clearinghouse, and it changes at any time, as long as they give the information to the market. At the inception of the contract, each party pays initial margin to the margin account held by his broker. Initial margin may be paid in interest-bearing securities, as I said, T-bills, so there is no interest cost. If future prices rises or fall, the longs have made a paper profit in case prices rises, and the short paper losses. The broker pays losses from and receives any profits into the margin accounts on the morning following the trading. Loss-making parties are required to restore their margin accounts to the required level, which is initial margin, during the course of the same day by payment of variation margin in cash. Margin in excess of the required level may be withdrawn by profit-making parties. Basically, if you don't provide the variation margin, if you don't bring your margin account to initial margin, once it was below the maintenance margin, your broker can close out all your position. You have to bring your margin account to the initial margin. So let's look at here an example. Let's initial margin for WTI contract, $5,000. This is just a hypothetical example, because yesterday when I checked it, it's much higher. The maintenance margin is $3,750 per contract. That one. Let's say that trader X bought a 10 September 2011 contract. This is an old example, delivery NYMEX crude oil push contract. It's a price of $100 on February 18, 2011. The broker will require the investor to deposit an initial margin of $50,000, because each contract they require $5,000. The trader bought 10 contracts, so it is $50,000 in margin account. This is the initial margin. At the end of each day, the margin account is adjusted to reflect the investor gain or loss. This practice is known as the marking to market to account. Whenever the margin account exceeds or falls below maintenance margin, $3,750 per contract, in our example, $37,500, then the customer receives a margin call from its broker, or broker receives a margin call actually from the exchange, then a transfer, broker transfer this margin call to the clients. If the margin account exceeds the maintenance margin, the investor is entitled, if the margin account exceeds the initial margin, the investor is entitled to withdraw any balance in the margin account in excess of the initial margin. Whenever it is below maintenance level, the customer has to deposit to bring the margin account to its initial margin level. The extra funds deposited are known as the variation margin. Let's look at here in our example. In this example, the contract is entered into on February 18 at $100, and the margin account balance shows $50,000. $5,000 for each account, and then there's 10 contract, therefore 50,000. On February 22nd, the balance in the margin account falls $7,500 below the maintenance levels, because 2 days in a row, prices went down from $100 to $98, so you are making cumulative loss of $20,000. $2 price differential, 2 times 1,000 barrel, which is 2,000, and then there's 10 contract, 20,000. Basically, it is bringing your margin account balance from 50,000 to 30,000. But maintenance margin for this one, 37,500. So your margin account shows falls below maintenance margin. Then you will get a margin call from your broker. Bring the margin account to initial margin. Basically, they are asking you to deposit $20,000 in your margin accounts. You have to deposit this $20,000 by the next day close of business. So I am assuming in this example, trader is not withdrawing any excess margin from its account. So let us think that this trader provides this variation margin by the end of February 23rd. As you can see here, on February 23rd, price improves $1 and the trader provides additional 20,000 margin. So margin account shows $60,000. Whenever margin account exceeds the initial margin, as I said, the trader can withdraw the difference between the margin account and the initial margin. Here, he is not withdrawing. On February 28th, again, after all the price declines since February 23rd, the trader margin account shows a balance of 20,000, which is smaller than maintenance margin of 37,500. To bring back the margin account to the initial margin, a margin call for 30,000 is sent out. The investor provides this margin amount by the end of next day. Then the price level starts increasing after February 28th, which is beneficial for the trader. Since prices are improving, the trader has excess margin. Assume that on March 4, the prices reached again $100, and his margin account shows $100,000, and the investor decides to close out the position by selling 10 contracts. The price is 100, and the investor has a cumulative loss of 0. The investor neither gained nor lost any money, since the price at which he bought 10 contracts and the price at which he sold his contracts were same, which is $100. Therefore, he didn't make any money or he didn't lose any money. His margin account shows 100,000. That is exactly the amount he put in his margin account, because initially he put 50,000, then he got 2 margin calls. In the first one, he paid 20,000, and the second one, he paid 30,000, total 100,000. So he didn't make any loss or gain. His $100 buy price, $100 sell price. Let's assume that on March 4, the price was 99 rather than hundreds. His margin account was showing balance of 90,000 the previous day. Basically, if the price doesn't change, margin account should show 90,000 still. The price he paid to buy the contract was 100, but he closed his position at a price of 99. So he makes a loss of $1 per barrel. For 10 contracts, this equates 10,000 loss. His loss is the difference between the margin balance and the amount of, which is 90,000, amount of margin payment he made, $100,000. What if the price was at 105 on March 4th, the day he closed his position? Price increased from 99 to 105, daily gain of 60,000. The margin account would have been $150,000. His profit will be 50,000 based on the margin account. This is exactly the number you get from the price differential between selling and buying multiplied by number of contracts and the contract units. So what if the trader X was a seller instead of buyer? What would his margin account look like? Is exactly opposite, because in a future and a derivatives market is a zero-sum game. It is one party gains at the expense of the other party. Basically, if there is a price decline, the investor who has a long position has to deposit extra funds, so-called variation margin, to bring the margin account to the initial level. On the other hand, the seller of the contract account will be credited. In practice, however, there is actually a chain of margins. Trader post margin with brokers, non-clearing brokers post margin with clearing brokers, and the clearing brokers post margin with the clearing houses. The margin posted by clearinghouse members with the clearinghouse is known as the clearing margin. However, in the case of clearinghouse member, there is an original margin, but no maintenance margin. So let's look at another example quickly. Suppose that you enter into a short futures contract to sell August natural gas contract for 1.75 per MMBTU. The size of the contract is 10,000 MMBTU. The initial margin is 2,000 and the maintenance margin is 1,700. What change in future price will lead to a margin call here? Of course, if the price increase more than 3 cents per MMBTU, then the trader should get a margin call to bring back the margin balance to initial margin of $2,000. Price increase is costing the seller since he promised to deliver the underlying asset at a lower price. So he has to bring his margin account back to initial level if the price rises more than 3 cents. Like forward contract, future contract also can be used for hedging, speculation, arbitrage purposes. Traditionally, many of the market participants in futures were hedgers. Hedgers use futures market to reduce particular risk arising from fluctuation in the price of underlying assets. Of course, it might not be possible to eliminate the risk completely due to basis risk, which I'm going to discuss later. For the time being, we assume that possibility of the perfect hedge, which completely eliminates the risk. A hedge might involve taking a long position or a short position. It's in the futures contract. Speculator, on the other hand, use this instrument to make profit by betting on the future direction of market price of the underlying asset. If your beliefs suggest that future price will be higher than what the market offers right now, you should go long. you are like buying low and selling high and making profit. Of course, arbitrageurs use derivatives and futures to take offsetting position in 2 or more instruments to lock in a profit. Let's look at here hedging using futures. As we said, a long futures hedge is appropriate when you know you will purchase an asset in the future and want to lock in the price. A short future hedge is appropriate when you know you will sell an asset in the future, want to lock in the price. Basically, a long hedge is appropriate when a company knows it will have to purchase a certain asset in the future, wants to lock in a price now. For example, an airline company knows that it will require 100,000 barrels of crude oil on September 1st, 2020 for its flight operation. The spot price of oil is now 39.5, and the future price for September delivery, which is the August contract, $40. In order to avoid any risk associated with price change between now and July, the airline company, between now and actually September, the airline company can buy crude oil now at 39.5 and then store it until September. In this case, the airline company has to pay storage cost as well as interest cost. Alternatively, it can hedge its position by taking a long position in 100 CME WTI August future contract. Each contract is for delivery of 1,000 barrels, so 100 contract, basically 100,000 barrels, and closing its position before the expiration by selling 100 such contracts. Suppose that spot price of oil on September 1st is $50, which should be very close to the future price. The airlines gains from future contract approximately is about $1 million, because 100,000 times 50 minus 40, because 50 is the spot price at that time and 40 is the future price he bought. In September, the airlines pays 5 million for the crude oil and making the net cost approximately $4 million. On the other hand, if the spot price in September turned out to be 35, and then of course the price again, the total cost $4 million. Regardless of spot price in September, total cost for airline company for 100,000 barrel at $40 future price is $4 million. Yes, it can make profit or loss in their hedge, but it is not important. The important thing here is to lock in a price you know. What price you are going to sell in September. Of course, we assume that there is a perfect hedge on this one, but standard future market trade only a small number of contracts per year. This concentrates the liquidity and gives good execution. However, it implies that contract maturity dates are unlikely to coincide exactly with the desired hedge dates. For example, cocoa leaf contract trades March, May, July, September, and December with contracts maturing on the third Friday of delivery month. This gives rise to basis risk, the term of the contract and the term of the hedge difference. Basically, up until now, we assume that hedgers can completely eliminate risk by taking future position opposite to their cash position. However, in reality, it is difficult to eliminate all risks. In order to eliminate all risks associated with cash position, the hedger must know the precise dates in the future when an asset would be bought or sold. Even if the hedger knows the precise date of sale, purchase or sale, he might have to close his or her position before its delivery month. Like WTI contract, you have to close it with June 22nd, delivery is July 1st. There might be a mismatch between the hedge period and available delivery dates. Even then, the hedger would need to find the same assets underlying the futures contract as the assets he or she is planning to buy or sell. For all these reasons, the hedger will face the basis risk, which can be defined as the difference between the spot price of the assets to be hedged. For example, in the case of jet fuel oil, spot price of jet fuel and the future price of the contract used. If you are using heating oil to hedge your jet fuel exposure, it's the difference between spot price of jet fuel minus future price of heating oil. If the assets to be hedged and the asset underlying the futures contract are the same, then we should expect actually the basis risk to be zero at the expiration of the futures contract, or very close to zero. Prior to expiration, the basis can be negative or positive. If the basis is positive, the spot price is greater than, I'm talking about same contract, for example, WTI contract, both hedging and futures contract. The spot price is greater than future price. If the basis is positive, I mean the spot price is greater than the future price, the situation is known as backwardation. If on the other hand, if the basis is negative, spot price is less than the future price, the situation is known as contango. If on the other hand, the asset to be hedged and the asset underlying the futures contract are different, a situation known as the cross hedging, then we would expect the basis risk to be different from zero, even at the expiration. Sometimes it's not possible to find futures contract for some commodities. Consider an airline company which is concerned about the future price of jet fuel oil rather than crude oil. Since there is no futures contract on jet fuel oil, the airline company tries to find an asset underlying the future contract which is highly correlated with the assets to be hedged. Maybe it is the heating oil, almost the correlation is about 90%. The high correlation result in low risk and the high hedge effectiveness, but still there is a basis risk over there. The basis is the difference, as I said, between the spot price of assets to be hedged and the future price of contract used. Basis risk arises because of uncertainty about the basis when the hedge is closed out. Basically, even in such situation, you are still exposed to markets price exposure. You are not hedging yourself 100%. Okay, there are two questions I want to talk about quickly. It is, I believe, very important. Then I move, I finish my lecture. What is the relationship of the future prices to the current spot price, which is S0? Is it about the backwardation and contango? The backwardation, how we define, when future price is lower than the spot price. The market is defined to be in backwardation. Often it is because the forward price is a more reflection of longer-term demand and supply dynamic, but spot price also, I mean, reveals information, temporary factors here. Backwardation, I mean, S is greater than F, spot price greater than future price. Backwardation is often a sign of tight spot markets, where traders are willing to pay a premium for immediate spot cargo. In addition, there may be also real value for buyers in holding on to some spare supplies. This is better known as the convenience yields. Basically, in a backwardation, convenience yields most probably is positive. In a contango, when the future price is higher than the spot price, the market is defined to be in contango. contango is often a sign of loose markets where immediate supply is plentiful and traded at a discount. In some markets, contango is very much a norm, as the commodity not sold in spot market will now have to be stored before it could be sold in the next period. Hence, the future price will be higher in order to take into account the storage cost. But more markets backwardation also can be normal. In practice, a portion of the curve, forward curve or future curve, could be in contango, another portion in backwardation. When people refer to spot price, they are actually referring to the 1 month or nearby future prices. This is the most liquid measure of where the most participants are trading and inputting information and expectation where prices should be. There is a separate spot price at which you can immediately demand physical oil and is marked at premium or discount relative to nearest future price, which also changes over time, although not by very much. The physically delivery or physical exchange price, they are referring to this actual true spot price rather than nearest future price. For example, I was talking with Barış Sanlı 2 weeks ago. I was telling him that one of the OPEC purpose is to bring oil market into backwardation from contango. Basically, now they have they are just trying to cut the current supply, but promising to increase the supply in the future. So in the future, we are going to have plentiful oil. For the time being, however, there is not much supply, although demand is also very low, but demand is recovering. So currently, WTI contract is still in contango. Brent is becoming much more backwardation if you look at. So it is very important how you are seeing market supplies or demand, supply-demand balances now and in the future. So if you believe in the future there is going to be a much more supply compared to demand, then it is going to be a loose market. So prices is going to be lower than today's prices, which implies a backwardation. So how about the second question? What is the relationship of future prices to the future spot price or the expected spot price? Of course, this is a very important question. The important feature of future prices is that they contain information about expected future spot price. In aggregation, any systematic deviation of future price from expected future spot price can be arbitraged by risk-neutral speculators. What I mean by risk-neutral speculator is someone who simply derives utility from expected returns and gives no regards to variance of returns. However, unlike what theory might suggest, there is some evidence of difference between these two prices, future price and expected spot price, in most commodity markets due to some embedded risk premia. A simple way to confirm this is to compare spot returns and roll return. Roll return is F over S0, STs. If there were no risk premia, roll returns would equal on average the spot price returns. But what we have seen, for example, WTI crude oil, how poorly spot returns and roll returns track each other. If anything, they have been negatively correlated. In practice, nobody who is rational in actually risk neutral, and people need compensation for taking risk. That's why future prices are not a good predictor of spot price. There are theories that consider what the systematic deviation of futures away from expected spot prices, what's called risk premium. For example, one such theory, Keynes-Hicks theory. Where does this risk premium come from? It comes from the counterparties, such as physical producers and consumers wanting to hedge their price risk and willing to pay a premium in return for transferring such risk to financial investors. These insights came from Keynes and Hicks, who argued that typically producers have a more substantial share of income linked to commodity prices than consumers. For instance, a corn farmer, fearful of a drop in corn prices, may decide to sell a portion of his crop at a discount to expected spot prices in return for price security and peace of mind. As a result, they have a greater need to hedge prices than their consuming counterparts. This causes hedging pressure to drive down the price of futures versus the expected future spot prices, a phenomenon known as normal backwardation. It is different from backwardation. When you're talking about backwardation, you're comparing the spot price and the future price. When you're talking about normal backwardation, you're comparing the future price with the expected spot price at time T1. Basically, in similar way, normal tango occurs when there are natural consumers who have a greater incentive to hedge their purchase price. For example, in the jet fuel market, an airline company concerned about a potential rise in the petroleum product prices may choose to hedge by purchasing jet fuel futures and pay a higher premium than expected spot price to guarantee a ceiling to their fuel cost. Hence, this consistent difference between future price and expected future spot price is the risk premium that can be considered as economic insurance commission paid by physical hedgers to speculate to assume the risk of the offsetting financial position. This distinction between physical hedgers and the speculators and the trading behavior will be, it is really, really important. Basically, we are talking about hedgers. They are usually short futures, and they're short futures, and the speculators are long. The only way speculators are willing to be long is if they expect to earn higher returns. Basically, future prices now they're offering should be lower than expected spot price. Basically, if speculators are expecting higher spot price in the future, then they should go long. This is also called normal backwardation. Okay, let's wrap up our discussion to talk about advantages and disadvantages of futures. Basically, they are regulated, so there are segregated accounts and the safeguards in terms of counterparty risk through clearinghouse, because clearinghouse takes the credit and operation risk, and it is very liquid. For example, if you look at crude oil, WTI crude oil, last Friday 89,000, but for the July contract, but August contract is much, much higher, and then you can hedge for almost 10 years, monthly hedging. So it is very transparent. in terms of prices, in terms of who's taking position, who's not, and it's also standardized. There's no surprise. This is one advantage. Also, it can be considered disadvantage if you want to have a customized, but most people would use this product as a hedge. They don't want to take delivery, but they want to have some certainty about what kind of product they are buying or selling. But these products are smaller volumes than OTC, over-the-counter product. For example, forwards and swaps, which we are going to discuss next week. They are not available for all assets. Basically, as I said, there's no futures contract for jet fuel or something. They are standardized. They are not custom-made. It might not serve your purpose of hedging, because if you are a jet fuel oil consumer like airline company, you might want to go to OTC markets to get jet fuel oil from a swap dealer, and that swap dealer in turn comes back to futures market to let's go take other position to neutralize his risk. Still have exposure to market risk, as this law is called basis risk, but they are not. Basically, it is much more transparent than OTC. So this week we discuss futures product. Next week I will discuss swaps. What's a swap? Mechanics of swaps, advantages and disadvantages of swaps, hedging using swaps, and I also like to talk about what has changed since Dodd-Frank Act, because before swaps were not regulated at all. Now they are regulated mostly. Sometimes we have standardized swaps. They have now OTC collateral, basically some clearing houses. So it is becoming like futurization of swaps, what I call. They are standard, they have the margins, they have the collateral, and swaps becoming kind of futures contract, but still there are available swaps out there which can be customized and which can be between two parties, buyer and seller. So next week we will discuss swaps. Hopefully I'll talk about swaps, and the following week we will finish with the discussion on options markets. Thank you so much. Gökberk.
Thank you, hocam. We will continue next week.